Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to look at a bunch of different pieces of the macroeconomic chain, if you will. The first segment, we're going to go through global food prices. They're back to 60-year highs when we go back over time, especially when we adjust for inflation. And then we're also going to look at debt, what's happening on the debt level globally, and then obviously our favorite topic, the supply chain. Then after that, we're going to go through the inflation data dump and what does it mean in terms of the inflation that came out on the CPI level, where do we expect inflation to go from that point, and as well as looking at PPI and what does that mean for corporations. Then we're going to break that down by labor costs when we look at labors per unit. What does it mean for small businesses? That we continue to get some of these mixed readings from small businesses that we want to talk about. And then the European data that came out, the ECB provided a pretty big update on what is happening for the PEPP or the monetary stimulus side. And we want to look at that as well as their economic data. And then we're going to go deeper into China's econ data miss, which was a big swing and a miss across the board from everything. But we want to really hone in on retail sales and the consumer, because that's where we continue to see some of the biggest risk over really the next, more than just the next few weeks, but months, years, in terms of where are they trying to go on the consumer side as they face another increase in COVID cases and more shutdowns going forward. So now that we've gone through some of that overview, let's look at the UN Food and Agricultural World Food Price Index. So you can see going back through 2001, we're back to the highs that we saw in 2007 and again in 2010. Now this is just straight index. This is just underlying pricing, and you can see that bounce back. That's a mixture of where the commodities or futures are trading, where shipping is, where fertilizers are pricing, seeds. All of these pieces come into play when you look at these different backdrops. So when you look at what is going to come going forward, there's the prospect of also subsidy cuts, which is going to become an even bigger issue, because this is what we see in terms of trading. This is what Bloomberg puts together to create their index. But it doesn't mean that's what the consumer pays, especially when you think of emerging markets. So when you start seeing subsidy cuts, which is going to continue in general, that's going to become a much bigger problem. So global food prices were up 33% in August from a year earlier, with vegetable oil, grains, and meat on the rise. Data from the United Nations Food and Agriculture Organization show, and is not likely to get better as extreme weather, again, freight, fertilizer, all the things that we've talked about get worse. And then the other piece is the dwindling foreign currency reserves, because when you look at inflation and that inflation backdrop, you need US dollars to help kind of insulate you in terms of how you're purchasing. And we've gone through the way dollars are traded and the way that, dollar moves throughout the system. And just to give a quick summary, and I don't want to spend too much time on this, but when you think about a company, so a company exports, an import company, and let's just take Kenya for an example. So Kenya is going to sit there and say, okay, we're going to buy grains. So we're going to go out and buy corn. They're going to buy that corn in dollars with dollars on hand. Then they're going to take that corn in. They are then going to sell it internally, but typically they're not going to sell it in dollars. They're going to sell it in local currency. So now the company has to go, and it could be a trading house and they have their own farming locally. So they're going to be able to sell some of that into the international market, take in dollars. But the delta, or the difference between what they took in dollars, they have to convert currency. So how do you convert currency? Well, they go to their central bank and say, look, I need to sell the local currency to buy dollars to continue to go out into the international market. And if the central bank is going to use their money to give and make that good, they have to worry about, well, where are they going to get that dollars on the back end? And that's where we see this cycle. And as you get those reserve currencies dwindling down, because there's more outflows than inflows, because when you look at the central bank, if people are buying, let's say $10 worth of goods, but are only importing $10 worth, but only exporting $3 worth, well, that's $7 you have to make up somehow because you want to maintain your balance of US dollars. So again, there's some of that balancing act that we continue to see. And that's where the foreign reserves that helps protect against inflation provides some of that backdrop, which is why we're starting to see that raising rate cycle. Now, when we take the grocery bills and we compare it to, and we mark it for inflation, so this is real food price index, annualized and adjusted to inflation. So when you look back, food is more expensive than almost any time in the past 60 years. So this is worse when you go back and look at where we were in 2008, 2007, in 2010. This is worse than that. We're now past that point in terms of, and this is why we continue to talk about uprisings, geopolitics. This is not a good situation to be in, and I'm not laughing because it's funny, but like just the seriousness of this, that it seems to be missed by a significant amount when you look at where the shortfalls are, where the numbers are, and again, just where we're going to sit on that geopolitical construct as we come into, because remember 2010, we go 2010 into 2011, the Arab Spring, and it coincided with the shortage in water and more importantly, the shortage in food. So then when we look at investors increasing less hedge, this is why I think it's amusing as we continue to go forward. Another today, Wednesday when we're filming this, it's a new all-time high as we continue to hit all-time highs on the regular. And here people are essentially saying we're going to continue going up. This is the investors increasingly less hedged. So that we're back to a point where everyone believes the world is in a great place and hedges are expensive and unnecessary. So it just means downside is cheap, and it might be worth looking at some of that downside. So when you look at the U.S. financial conditions, this is just looking how Goldman Sachs assesses it. We still have record low financial conditions, which just means it's easier to get loans, money in general. Everything is cheap. Money is cheap. Money is fluid throughout the system as we continue to have essentially $1.1 to $1.8 trillion going into the RRP every single night. But even though we have this inflation, even though we have this backdrop, there is a certain amount of views that the economy is slowing. Again, still growing, but slowing. And that's putting pressure on where yields are. But you also have more QE purchases than issuance over the past 90 days. So when you look at the shift and that's why I think it's a good headline, expect a complete turnaround of that ratio. And that's when you get that ratio spin, and that's when you get that pressure, because when you're buying more debt bonds than are available, you're going to drive down the yield and drive up the price. You also had international entities coming in and buying more treasuries, back to our point on how do you pull in more dollars, and why not buy treasuries and take them in on interest payments. So again, there's a lot of ways to try to manage that, but without QE, that's where we get a much bigger backdrop. That's where we get the problem. Now, we're coming up to that fiscal cliff or the bond the debt ceiling, which is always going to be a fun period of time. But there's a lot of things to consider here, because as QE tapers, and you still have the Treasury needing to borrow a significant amount, because we're about $3.4 trillion short, or 53% of our budget is short. That means that we have to go out and borrow it. So if QE pulls back, again, you're going to kind of see where this is going to go from here. We do have that demand spike that we got in August and September, and it comes back to that raising rate cycle. So when you look at the emerging markets, they're going out, they're starting to raise rates, they're trying to get in front of some of this inflation. So what else do you need? You also need dollars, treasuries, things to try to instill a certain amount of confidence in the underlying, not the economy, but also more along their currency side to have that backdrop and to try to maintain activities as normal. Now, we did a show on the USD dynamics, and I'm happy to post that again because it's still relevant for the conversation. But then when we look at debt levels, so even though we continue to see these debt levels climb, as we've been talking about, we continue to see these debt levels going up, continuing going up, and we're now getting above where we were in World War II. The difference also comes in borrowing costs, because borrowing costs have not followed the same way And there's a mixture of things. Obviously a lot of central bank support, a lot of central banks buying this debt. And there's also, when you look at just the 20 advanced economies, that's where the central banks are the most active. So that's where they're keeping this depressed rate down. And by keeping money so fluid, again, you're also pushing people down that risk curve where why am I gonna buy investment grade debt if I can go out and buy some riskier equities or some riskier debt or some high yield debt or some high yield sovereign debt, and again moving down that risk curve. So that also creates that conundrum and that risk that really needs to be understood. And what does it mean to GDP? So government debt versus 10-year bond yields in the G10, Eurozone, and emerging markets. So when you look at 2012 of whatever it takes, because remember when we look at the European crisis, you had Japan sitting there at 225% of GDP. You have Great Britain. But then when you look at over on 2021, and this is coming from the IIF, whereas 2021 or whatever, just not whatever it takes, just whatever it is, government debt versus 10-year bond yields in the G10 Eurozone. Here you can see the emerging markets really getting pinched. And that's where I want to look at, because emerging markets is where I see the most risk going forward. When I talk about defaults, when I talk about the stress that is going to be placed on them from food, from inflation, from just daily living, and how are you going to manage that if you're struggling on a slowing economic backdrop and your exports are going to get hindered, which is going to limit the amount of dollars you take in and create this kind of never-ending cycle, while all of this continues to move to the right on the government gross debt in percent of GDP terms, because we went from 225 to 254% for Japan, and now 215% for Great Britain. So now looking at this a little bit differently. So this is just looking at where we sit right now on the market access is the key side, because market access is the biggest piece. Because when you look at 2012 and you look at Italy, you look at Greece, you look at Belgium, and then you look at 2021 and you look at where a lot of those entities have come down, that's the availability. That's what we're talking about with the ECB stepping in, buying. So, but then when you look at this underlying piece, it's the unknown of, well, how much pressure was there going to continue? Because the one on the right is looking at general government interest cost and debt levels. So that cost is going to be the biggest factor going forward. And if you look at Italy and their ability to roll at much better rates, because you have to look at this on a span of time or duration. So as some of these expire, especially or mature, and you go out and roll it forward, you're going to be able to roll it at a better rate. So you're going to continue to see this walk down as long as obviously rates stay where they are. But on the emerging market side, you're starting to get a little bit of that bleed back up as there's some of that concern in terms of inflation and that growth on the emerging markets. So then when you look at total debt to GDP ratios in major economies, you're getting an idea of kind of where we sit right now. So Japan is, and this is just looking at the Bank of International Settlements. So when you look at total debt to GDP ratios, and again, total debt, not just one piece, you have Japan that is over 400%, and you have the US, Euro area, and China sitting just under that 300% capacity. Depending on how you factor in China, it's anywhere from 285% to about 335%. That's depending on the GDP you're using for the calculation, the amount of off-balance sheet that's coming on balance sheet. So again, there's a lot of ways to spin this number and a lot of ways to make this look worse or better. I mean, obviously the fun with statistics and percentages. One of the things that we wanted to talk about on the technology side, we've been discussing this, and it was the silica that we've been talking about. So the die, the chip's brain. So when you look at the substrate, you have to look at what is happening in the substrate. So the substrate connects the die to the motherboard. The different contact points deliver power and data between the die and the rest of the computer. So something very similar, simple, a very low margin product, But that is where we're seeing some of the biggest shortfalls. So here's a good chart on the supply gap. So forecasts show demand for advanced chip substrates increasingly outstripping supply. Square feet of manufacturing space. When you look at demand and you look at capacity, that's where we continue to see this problem. So figures are estimated, therefore, they refer to an advanced type of substrate used in CPUs and other powerful chips. So that's the important thing, because when you look at computation and just where things are going in general, we're seeing this push forward. We're seeing, again, this movement as we go through the capacity, as we go through the demand function. There is a lot of movement in terms of not just, okay, Taiwan is struggling, but the raw materials. We can talk about where demand is, and we've been saying that demand was going up, but the raw materials is where we see the stickiness coming through. We see the problems overall, and that's how it continues to expand over this time period, keeping us in this fairly tight market, but also increasing cost. And that's why we don't think, or at least I don't think, technology in general is going to be that deflationary cycle that we're so used to seeing, especially when we look at just something as simple as the substrate. And that's what I think is missed when because we can talk about how shipping is transitory, and that's going to, over the next 12 months, that'll help, demand will come down, supply will come up, we'll see some normalization. But this is something that doesn't just go away. We can get demand slowing, that will help, but there is that offset that we always think is that we have to look at as we go forward. Speaking of which, the freight rates accelerate in August with the largest annual gain in more than 15 years. So when you look at the rate and just freight rates in general, you can see that we're still not done. When you look at August, when you look at the expansion, you look at the problems in general. And again, they don't get any better as we go into September. And this is looking at it a little bit differently with the cash expenditures index. When you look at just where we sit, again, continuing to go to the highs that we've seen since 2010 on expenditures index. And again, there's just year over year, continuing to see this grind higher more and more, and just increasing the cost in general. So then when you look at freight rates, this is where going back to January 2010, freight rates are back to that 21 year to 11 year high. And there's very little to see this, again, really adjusting in the near term based on what we're seeing, as we have U.S. ports are seeing high congestion rates. And it's not just the U.S. ports, it's also areas within Asia, which is the spot that we get a significant amount of our goods from, whether it be finished or semi-finished. And this is where we continue to see this backdrop and this price issue that originates in Asia and gets transferred over into U.S. markets. And then obviously U.S. ports are congested, so then that creates a bigger issue. And you can see how this can compound itself to not go away in just a month's time. And then when you look at total deal flow in general, so we have companies trying to take advantage. What is it? But everything is free. Everything is free. Money is free. So let's go out and do M&A. Why not go out and do M&A and try to capture this? So when you look at total deal volume, we're approaching $4 trillion in M&A around the world. And it's really across all industries and companies just trying to take advantage of the fact that the money is so cheap with these leveraged buyouts. But what is still not continuing to happen? Well, waiting container ships are on the rise at America's top 3 ports. So when you look at M&A, so what are companies trying to do? They're trying to sit there and say, okay, well, I have all of this cash. I really can't sit here and try to, why am I going to buy up my inventory? I have this cheap cash. I have these assets that I can go out and purchase, and this will pass over time. But I want to look at the longer structure and the longer corporate backdrop to try to grow and expand on a worldwide level and try to get those economies of scale, that vertical integration, maybe horizontal integration, depending on the industry. But because there's little that can be done about just how bad this is and the amount of money that's going into it. So you have money that's being bled through right now, especially in the U.S. You have the ability to pass through some of that cost, but we're continuing to see some of these backdrops, and things are continuing to get worse through September. Back to my point of prices are not going down, they're only going to continue to go up. And then when we look at just the composite container freight benchmark, $10,000 per 40-foot box. Then you look at the Shanghai Shipping Exchange, China Containerized Freight Index, you're just seeing, again, those levels higher. And when you look at just where those pressures are in the U.S., this is just looking at what is happening in Long Beach. You can see cargo vessels, tankers, and this is what we were talking about, especially going back to the EIA show. Tankers are also caught in this congestion. It's not like, oh, I'm just going to skip everybody and get in and get out. You need to wait in line. You have to signal demurrage. You have to wait to be called in. So again, this is a significant backlog that continues to build out along the coast. Now, when you start looking at, well, how are we going to address this? China industrial output of metal containers. Well, let's build more metal containers. And in July, they built 22.2 million. So we're trying to see some of this in terms of building more containers, trying to solidify the supply chain, trying to move some of this through. And there's a lot of congestion. All in all, it's all pointing to prices going up. It's all pointing to more pressure. And these are the issues that we're going to go into more detail when we talk about inflation and where do we see things going, not just over the next month, but over the next 6 months, 12 months, over that time period. Where are we going to get deflation, inflation, stagflation, mixture of something, and depending on what, we're going to go through that in the next segment.